Yeah, you come or you know I'm in a class or you trek. Where you where you now? Honestly, if I go back to school, I won't. I say go back to read.
Mute your
Can everybody hear me now? Hello?
Yes. Yes.
Are you guys hearing me before?
No.
Oh my God. I didn't know that I muted everybody. Sorry, please. So what I'm saying that we're going to do chapter 15 to 16 today. Chapter 16 is about disability insurance. So I said it yesterday that if there is no loss, there'll be no benefit. If you have health insurance, if you're not sick, you not get benefit. If you have auto insurance, if there's no accident, there's no reimbursement. Whatever you have put in insurance, anything called insurance, if there's no loss, you cannot get any benefit. But then some people will ask, do I then need it? Yes, of course, you need it, because the time you will need it, you will not have it. It's the same thing with life insurance. The time you will need life insurance, definitely you may not have it then. So you look at it, it's better to get it when you don't need it, so that when you need it, you have it. But if you don't get it when you don't need it, when you need it, you're not going to get nothing. And there's no way you can retire stress-free, hurt-free, poverty-free, without having a good retirement plan. And in good reasoning, if we all have known what we are trying to know today, our retirement planning should start from the first day we are employed. From that first day, for those who, most of us are immigrants. From that first, you came to America, from the first day you have your papers to start working, that is when you start planning for your retirement. Then for our children, immediately they come out from college, start their first job, that is when they should start planning for their retirement. Retirement is good to start it on time. Planning of it is supposed to start it on time. Start planning retirement from 20 years, 25 years. By the time you get to 60 years, you have gotten enough to take care of you. You have gotten enough to live in your house, and if the person is sick to die, if the person dies in his house, then going to nursing home or facilities. That's the truth. You can be in your home, bring people, if you're old enough, you can bring, if you have the money, you can be in your home, bring people to come out to your house and take care of you. But if you do not, definitely nursing home or facilities. And of course, you know what happened to nursing home or facility. Immediately you step their foot there, it's almost, you are now there waiting for that. So these are something that people don't want to experience. And how do we avoid it? By starting today. No time is late. We can start today to remedy it by starting today to start doing those things we're supposed to do. Those things are what? At least have a life insurance. At least have your annuity. Have a life insurance is tailored through different ways. If your intention was to retire stress-free, good. You design it based on that. If your intention is to what? To get much cash as accumulation or for protection, yeah, you design it towards that way. We have a lot of different types of policies that can take care of you. One of such policies are disability insurance, income insurance. Of course, those who are working now, you should have it. Yes, I have it. When I was working, I didn't know that I signed in for it. I didn't know that I collecting the money, the monthly from my paycheck. Honestly, I didn't know. Until when I retired, they now begin to send me letter. Guess how much I'm taking from my check every month for disability income insurance is, I think, $84. I didn't know. So do I need to continue it? Of course. I have to sign to, instead of making it a group, I now make it an individual. So disability income insurance will come up to play a good role for you when you cannot work due to disability. Disability can come in form of sickness where you cannot be able to do something. It can come in form of losing one hand or losing one leg. It can come off you are terminally ill, you cannot do nothing. Remember, when somebody is sick, what kills most times is not the sickness. What kills is the economic hardship around you and your family. That's the best, that's the thing that normal, that is the one that hurts a lot, not the sickness itself. The sickness contribute. But if I was watching one, how should I get that in? I was watching one thing on, is it YouTube or what? Well, Instagram. We have one guy, the guy, I'm sorry to say it, it's people from Nigeria. I'm sorry to say it, I'm from Nigeria too. The guy is in Saudi Arabia. It's like he's sick. They took him to Saudi Arabia. So he went to one of the hospital. He is in the hospital. They are providing everything for him. He was using camera to go through the rooms in the hospital, show his big screen of television. He showed everything, show how the room is, show his toilet, show everything, and was asking the person that video him, say, even if I'm sick, he now showed people, they brought chicken, fried rice, and chicken, chicken for him. The guy said, do not think he's going to go. He's going to stay here 2 months. So, you see, so that in such a case, you see, that guy for that 2 months, he's there. If he married the definition of disability, the income he wasted within that 2 months will be paid to him. So that's disability. It works as workers' compensation. But the workers' compensation is based on what? You are having injury on while at work. Workers' compensation does not help when you go outside and get accidents. No. Injury at work. Disability income insurance covers whether at work or anywhere that causes the disability. So you can see workers' compensation is only for you when it's happening in the work, injury at work. That's exactly what it is. So we're going to see disability income insurance today. We're going to see why it's called disability income insurance and what we should learn from it and the need for us to have it if it's possible. If you're still working, you can have it. It's not much. Probably $20, $35 from your paycheck every 2 months. By the time you get it, it gets up to maybe $60, $70, or $80. So imagine waking up one early morning, unable to perform your job due to what? Unexpected illness or injury. So disability can come in form of illness or injury. How would you pay your bills? How long could you savings sustain you? That is a great question all of us should ask. Imagine, because nobody knows about tomorrow. Imagine the person who wake up could not do nothing. How would you pay your bills? Without those bills stop coming? Of course, no. They continue to come. So how would you pay your bills? How long would you savings sustain you? For most Americans, the financial impact of disability can be devastating, sometimes even more financially damaging than death. This is why disability insurance is often called living death insurance. So disability insurance is called what? Living death insurance. So while most people understand the need for life insurance, they overlook disability coverage despite the fact that working age individuals are more likely to become disabled than they died prematurely. So according to statistics, a 35-year-old has about 1 in 3 chances of what? Experiencing a disability lasting at least 90 days before reaching retirement age. Disability income insurance serves as a financial safety net, providing regular income when you cannot work due to covered illness or injury. So it's not all about injury, illness. It transfers the potential catastrophic financial risk of disability to an insurance company in exchange for predictable premium payments. They will pay you as regards to what your income is. That's what they do. They pay you as regards to what your income is. So it's a single policy that anybody can enter and have. It's very necessary that people should get it, no matter how small. One thing with insurance is that nobody forces you to do that. Force yourself to do that and do according to your means. And if you eliminate some of the things you are doing that is not necessary, you can get any type of insurance you want. That is the basic truth. There are some things you don't need, you are doing. You can eliminate them and get as more as you can. So let's watch this video before we go ahead.
Welcome to the chapter on disability income insurance. In this chapter, we will examine a crucial yet often underestimated form of financial protection, Disability income insurance provides essential support if an individual becomes unable to work due to illness or injury. Consider this: an individual waking up one morning unable to perform their job due to an unexpected illness or injury. In such a case, how would they manage their financial obligations? For many Americans, the economic consequences of a disability can be severe, often more financially disruptive than death itself. Disability income insurance serves as a financial safety net, providing regular income when you cannot work due to a covered illness or injury. It transfers the potentially catastrophic financial risk of disability to an insurance company in exchange for predictable premium payments. In this chapter, we'll explore how disability insurance works in both the public and private sectors. You'll learn about the various forms of disability coverage available, from Social Security disability insurance to individual and group policies. By the end of this chapter, you'll be able to explain the purpose and importance of disability income insurance in financial planning, differentiate between the various definitions of disability used in insurance policies, identify how individuals qualify for benefits under different policy types, compare government disability programs with private disability insurance options, distinguish between individual and group disability income insurance features, analyze the business applications of disability insurance for protecting companies and owners, and finally, explain how disability insurance benefits are taxed based on premium payment sources. We'll begin by exploring the basic concepts of disability insurance, including how it defines disability, which can vary significantly between policies. The own occupation definition classifies an individual as disabled if they are unable to perform the duties of their specific profession. For example, a surgeon experiencing hand tremors would be considered disabled under this definition, as they can no longer carry out the essential tasks of their role. Under the any occupation definition, an individual is considered disabled only if they are unable to perform any job for which they are reasonably qualified based on their education, training, or experience. And the Social Security Administration definition requires the inability to engage in any substantial gainful activity due to a condition expected to last at least 12 months or result in death. We'll examine government programs like Social Security disability insurance and workers' compensation, which provide basic coverage but often have strict eligibility requirements and limited benefits. Then we'll compare individual and group disability policies, noting their different features, benefits, and costs. Individual policies offer more customization but at a higher price, while group policies provide cost-effective coverage with standardized benefits. For business owners, we'll explore specialized disability insurance products that help ensure continuity when owners or key employees become disabled. Business overhead expense insurance covers ongoing operational costs if the owner becomes disabled. Disability buyout policies fund the purchase of a disabled partner's share. Key person disability insurance compensates a business when a key employee becomes disabled. Finally, we'll examine how disability benefits are taxed, noting the important principle that money is generally taxed only once, either when premiums are paid or when benefits are received, but not both. A solid understanding of disability income insurance is essential for passing the state insurance exam. So let's get started. The concepts covered in this chapter will equip you with the knowledge needed to accurately explain this often overlooked coverage to clients and demonstrate competency on exam questions related to disability income insurance.
Yeah. So you can see how important disability insurance is. It's something that somebody need to have. It's something that somebody need to have. And believe me, it's easy to get while you're at job. It's easy and cheap to get it as a group plan. Then when you get out from your job and you retire, you cannot convert it to your own individual. It still maintain the same amount you are paying for this one in particular. But for life insurance, if you convert to individual, it may be pricey, such as health insurance too. But disability insurance remains because your income in that particular job remains the same. If you are getting maybe 6,000, 7,000 a month, then it's distributed on that 7,000 you're making a month. So when if you get disability, at least you be paid close to 3/4 of that amount every month. All right. So our normal way is to go through the.
I have a question. The disability insurance, is it not like the one they call workers' compensation?
No.
Right?
No. Workers' compensation is when you get injury at work.
Oh, okay.
It can trigger workers' compensation if there's injury at work. But disability insurance covers both injury and illness.
Okay. I think that's the one like short time, 3 months, right?
No.
Okay.
Those ones are quite different. This one is like a policy. For instance,
Okay.
if you are working where they have this group insurance, if you go on the group insurance, you get your disability income insurance there. You get the disability. You can sign for it.
All right.
Yeah.
Okay.
It is really good.
Yeah, I'll do that before I leave.
So
Before I leave here.
So
because I have the one that in case if you are sick for like maybe 3 months, they'll be paying you like 2,000 every month. So they are taking money from my account every
check. All right, what you're gonna do? Check if you log in or if you have any HR person. Check. Ask him. This one they take 3 months and 6 months. What is it? And the one disability insurance, is this the same thing with your disability insurance? Because companies have differently. They have their own. Just find out what actually the one of 3 months and 6 months, what it is.
Okay.
Yeah.
All right, thank you.
All right. So let's look at accidental means.
Mr. Beck, please. Is this one different from the accident and death benefit?
It's quite different. We're going to see accidental insurance. We're going to see that one.
Okay.
The only difference between accidental insurance is this. Accidental insurance, most insurance companies doesn't want to give it. They give, but the premium is high. Because what? If the person who has accidental insurance died, AD&D, the person dies, the death benefit will be twice or triple. So most times, because of that amount, insurance company do not want to. If they give it to you, then it's gonna be expensive.
I have one that is saying like the one limb, one leg, one eye, one.
Yeah, that is the AD&D.
Oh, okay.
AD&D.
Does it cover your children too when you are not there?
Sometimes it's a rider.
Okay.
It's a rider. If you have a policy, you can still have it as a rider. You can still have it as a single policy.
Okay. Thank you so much.
So let's look at accidental means is when something is accidental, it means unforeseen, it means unexpected, it means unintended event that happened, you did not plan it to happen. That is accidental means. So when you're talking about accidental bodily injury, it's as a result of accident, which means that it happens when you do not expect it. It's an unforeseen event, it's an unexpected event, it's an unintended event. You do not plan it to happen. That is when it's an accident. So that is accidental means. This applies to an accident policy which requires the cause and result of a mishap to be accidental for any claim to be payable. So most of the policy that have accident policy, it requires you before the payment will be made. Before, of course, I said if there is no loss, there is no benefit. So before that claim can be filed, there must have been an accident. The cause of that what can make you to file the claim must be through accident. The loss must be through accident. So that's the accidental means. Then accidental result, which is accidental bodily injury, is an unintended consequences of an action that the insured takes, even if undertaken voluntarily. That accidental result. Then let's look at additional monthly benefits. Is a rider. A and B is a rider that can supplement employer-provided disability. There's one thing everybody should know. In life insurance or health insurance, everything insurance, there is a whole lot of policies. It depends on what you want. You write policy based on your own needs and family needs. My own family needs may not be the same with your own family needs. You check around you, write a policy based on your needs. Your need may be to have a maximum protection for the children. Another person's need may be to provide to make sure that the children go to school without loan. Another person's need may be to accumulate wealth for the family. So there's different needs. So you write your policy, tailor your policy towards that needs. And that's the more reason why as an agent, before you can write policy for somebody, you have to do what? Do a need analysis. In the need analysis, you're going to get, in fact, you're going to get everything that person owns, every assets and liability. You're going to bring them down, write them down to be able to know what actually this person needs. After you key in all those things in the system will come out to tell you, look at the type of policy the person needs and the amount that can sustain that person to live be a happily retired person. So need analysis is needed. And when you start the business, of course, when the reteaching starts, when you pass the exam, now begin to enter the teaching, then we're going to show you how you can do need analysis. Even how you can start by doing your own need analysis. Because you can do your own need analysis. As an agent, you do your own need analysis. You have access to the WFG platform. You can be able to key in those numbers, find out exactly what your family needs. So there's always a need for need analysis and a policy based on your needs. So additional monthly benefit A and B is a rider that can supplement employer-provided disability benefits, cover gaps in social security, disability insurance, or help pay for extra initial expenses if a person becomes disabled. That is additional monthly benefit. So this is a rider. Let's assume somebody have a accidental AD&D policy as a single policy. You can now put monthly benefits rider on it. Remember what we say about rider? Rider is just something you put in to beautify the policy, to make the policy look beautiful, to make it look beneficial. That's what riders does. So any substantial gainful activity, this phrase is an essential part of the Social Security definition of disability. Remember, when we did Social Security definition of disability, we talk about what Social Security regards as a disability. And before you can file Social Security disability, you must attain that level. And what is it? He said, for you to be considered to be disabled in Social Security, you must have not been able to do any occupation. Even your own occupation, you cannot be able to do it. And that disability must last at least 12 months or may lead to death. That is Social Security definition of disability. So if you fight Social Security disability and do not meet all these terms, you're not going to qualify to get Social Security disability. So any substantial gainful activity, this phrase is what? Used to Social Security disability. Definition of Social Security disability is what? For you to be considered to be disabled by Social Security definition, you must have that disability for at least 12 months, or that disability may lead to death. And for such disability to happen, you cannot be able to do any occupation, including what you were known to be doing, including what you qualify based on including the occupation you are doing based on your qualification, your training, or your education, or your experience. You cannot be able to do it. That's one definition of disability by Social Security. So you have to meet it. One, you cannot be able to do any occupation. Two, that disability will last at least 12 months. And three, that disability may lead to death. So you can see the conditions attached to it. So we said let me see this one. All right, the law defined disability as the inability to do any substantial gainful work due to any medical, determinable, physical, or mental impairment, which can be expected to result in death, or which has lasted or can be expected to last for continuous period of not less than 12 months. So when we say any occupation, we means for a policy to provide disability income benefit, the definition of total disability requires the insured to be unable to perform any job for which that insured is reasonably suited by reason of education, training, or experience. So, however, in some states, this may be called any occupation for which the insured is reasonably suited. So, any occupation which you are trained for by reason of education, training, experience, if you cannot be able to do it, then you are considered to be disabled. And that disability will last at least not less than 12 months and may lead to death. So the benefit period, when you file a claim, what is the benefit period? Is the maximum length of time during which a benefit can be paid per disability claim. Like somebody was talking about 3 months, 6 months, the first disability income, first 3 months, and the other one 6 months. The disability, the benefit period is now 3 months. The benefit period is now 6 months. If you get the first 3 months, the benefit period is what? 3 months. If you get the first 6 months, the benefit period is 6 months. So now we want to connect benefit period with premium. I hope everybody knows that premium comes because of risk. Your risk classification is the determinant of your premium. Your age is the determinant of your premium. Your sex is the determinant of your premium. Even your occupation, or the kind of job you're doing, is a determinant of your premium. The high risk you have, the more premium you paid. The low risk you have, the less premium you paid. So let's link the benefit period with a premium. Benefit period, which we know is what? What's the length of time of which you pay that premium? I mean, the benefit comes to you. If you file a claim, is approved, the length of time in which you continue to collect the benefit until it ends is what we call the benefit period. Now, let's link it to your premium. All of us know what premium is. Now, the longer the benefit period, the higher the cost or the premium of the policy. Please, I want everyone to get this one. It's confusing, but get it. If you have a paper, you can write it down. What benefit period is, connect it with the premium. We said the longer the benefit period. And what's that benefit period? The length of time during which benefit can be paid per disability claim. That's the benefit period. We now said the longer the benefit period, the higher the cost or the premium of the policy. Is that clear to everybody? The longer the benefit period. For the benefit period to be longer, what means that you have to pay higher cost of premium. And when you are paying higher cost of premium, what does it mean? But probably your policy may be of large amount. Or probably the person has higher risk. So these are the two things that can make you to pay larger premium. Higher risk, classification, and what? Large amount of policy. These are the two factors that can make you to pay higher premium. There's no other way you can pay higher premium. If not that you probably have $4 million policy, $5 million policy. You know that the premium will be higher. Or probably have 200,000 policy, and you have you are substandard. You know definitely the premium will be higher. But remember, for the benefit period to be longer, there should be a high cost of premium of the policy. So let's assume that your policy is more, $5.5 million policy. Yeah, the benefit period will be longer. So business overhead, let me say it this way. If your premium is so small, definitely that you're not gonna get much benefit period. Your benefit period will be very short. Of course, you know that. If you're paying more, you have more time to take the benefit. If you're paying less, you have less time to take the benefit. So let's look at change of occupation. Business overhead expense insurance. For those who have business here, we cannot stop to say it, that your tax dependent on the profit you make. And the law allows you to have key employee policy. Of course, the law allows you that. The law allows you to have executive bonus. What does the key employee policy? It comes in to help when the company cannot do that in which the key employee is doing it, because the key employee may have died, or may have got injured, or may have disabled. So if you have a key employee policy, the benefit you get from that will help you to do what? To be able to get another person who can take the same position that person is doing. So key employee policy is needed. And when you get that key employee policy, the company will be paying the premium. When you have that executive bonus, the company will be paying for the premium. And all of them will go to business overhead expenses. And remember, your tax you're filing, you pay tax on your profit. You don't pay tax on your expenses. You pay tax on the policy. On the profit. So now, for you to pay, since their business overhead expenses now increase, what do you think will happen to your profit? Your profit will drop. Your profit definitely will drop. If the expenses is much, dependent on the annual income, you see definitely the profit will drop, because income minus expense will give you profit. So your tax will not be based on your profit. You never pay tax on the expense, please. You pay tax only on the profit. So change of occupation provision. In disability income insurance, there is provision for change of occupation. If you change any occupation, you have to let the insured know. This provision allows the insurer, the insurer is the insurance company, to adjust benefit or premium automatically if it becomes aware that the insured changed occupation without notifying their insurance carrier. By law, whenever you change occupation, you should be able to notify your insurance carrier. More especially when you change occupation from lower risk to higher risk, or from higher risk to lower risk. If you change occupation from lower risk to higher risk, definitely know that your premium will be affected. Are they going to increase your first amount? Of course, no. They will decrease the first amount, and when the first amount is decreased, what happens? Your premium will go down. Yeah, let me finish here. So, change of occupation, you have to let them know. If you change occupation from higher to lower risk, if you're working on a higher risk occupation, let's assume you're a pilot. And then you wrote the policy when you're a pilot, now decide to become a clerk in the office. You have reduced the risk. Let the company know. They will now base their premium on their lower risk, which is the clerk you are. What do you think will happen to your premium? Your premium will drop from higher risk class, which is substandard, to what? Maybe preferred or preferred plus. So bringing it down, that will bring your premium. And of course, if you equally change from this lower risk to higher risk, what will happen? Your premium will change. They will reduce your first amount to make sure you'll be able to pay it. Your premium will change. So it can work on two ways, meaning if anytime you change your occupation, please let your insurance policy know. Not when you are working as a nurse, you get another job as a nurse. No. When you're working as a nurse, one day you wake up and say, what you want to be from today you want to change to become a diver, you have to let them know. Or you a diver, and I'm saying, oh, I have retired from that job. I'm no longer doing it. Today, I'm going to work as a nurse. Then you have to let them know that you're no longer a diver, you're now a nurse. That will change everything. But are they going to increase your first amount? Of course, no. Nothing you do that insurance company increase your first amount. Remember that. They will
So what's the benefit of telling them? It lowers the premium? Oh, the face amount won't change, but the premium will change if
Of
it's a
course,
better,
yes.
a better profession. Got you.
So the insurance company can never can never increase your first amount. Rather, they will decrease it to help you be able to pay the premium. Because they are much after you paying the premium, not necessarily on how much you have first amount was, but they want you to, any amount you have, you can be able to pay the premium with just stress-free. Of course, they will ask you your income before the approval is given. So that is the change of occupation provision. Concurrent disability. Somebody is disabled, file a claim in that disability. Along the line, has another disability occurring in the same time, which is concurrent disability. What happened here? It applies when multiple events contribute to the same disability. And when a disability from a single occurrence fits multiple definitions, in either case, the insured may only claim one benefit. You had an accident, maybe you cut your leg. You cut your leg, you had an accident, cut leg. Then you are going to hospital to go and treat the leg you cut. You had another accident, cut hand. You would expect the insurance company to be paying you that cut for the leg, pay you benefit for the leg you cut, and pay you another benefit for the hand they cut. No. They will pay you one benefit. I hope everybody got it. Everybody get that concurrent disability, of course. Then, this chapter is big. Confinement disability. It depends on where you are. Some people can be indoors, confined to hospital, confined to home. If you're confined to home, definitely you're going to be known that you're confined to home. If you're confined to hospital, of course, they want to know. So confinement disability is a definition of disability that requires the insured to stay indoors to be considered disabled. So if you're confined to home, definitely you're going to stay indoors for it to be considered disabled. If you're confined to hospital, definitely you're going to be in the hospital. So coordination of benefit, the clause defined process used when more than one policy provided coverage to a loss. One loss have more than two coverage. So the process determines the order in which insurance companies pay a claim. Group insurance policy use it when another source of coverage, such as Social Security or workers' compensation, also cover the same loss. In disability insurance, group benefits are coordinated with that is reduced by Social Security and workers' compensation. Let me tell you guys something. If you're working and have injury at work, now you have your workers' compensation triggered off. Now they are paying you workers' compensation. Probably due to the sickness, you now go to hospital and you want to use your Medicare. They will not approve that. If you are working home health, you remember, if you understand what I said, they will not allow you to be on Medicare while you're on workers' compensation. You cannot take two at the same time. You must take one.
Really?
Yes.
Yeah. So if you're, say, for instance,
we're not hearing you.
no, you're on workers' comp and you went to the hospital, but you have Medicare. Because and you have Medicare, you're saying when you get to the hospital, they only can use, you cannot accept the Medicare?
They will not approve you with workers' comp and Medicare at the same time. Yes. They will not.
I didn't know workers' comp was. I didn't know workers' comp would intertwine with Medicare. It would
Yes,
have
you do. You
an
do.
impact on Medicare.
You do.
That's what
Yes.
bothers me.
You do.
The-
If you have worked in home health, you will understand it clearly. They will not.
Yeah, I do. That's why I'm so concerned. I used to. Not anymore. That's why I'm so concerned. I didn't know that. Mm-mm.
So group insurance policies use it when another source of coverage, such as Social Security or workers' compensation, also cover the same loss. In disability insurance, group benefits are coordinated with, that is, reduced by Social Security and workers' compensation. Cost of living adjustment color rider. Cost of living adjustment color rider provides an automatic increase in benefits, typically tied to consumer price index to offset the effect of inflation. That is cost of adjustment rider, color rider. It's tied to what? It's tied to policies. What does it do? It fights the effect of inflation. See, this is always there, but how many people have it? Cost of adjustment rider. Because the rider, remember, is a beauticians that help the policy to look good. How many people have it on their policy? It's a rider. Remember, it doesn't come free. So
Mm.
most of us, we just buy the policy, whatever the automatic rider we have, that's only where we think we have gotten the best. No, you can add different riders in your policy to make it look good. But the only thing is this, you have to pay for them. There's an additional fee for any rider you add in your policy. But if somebody have the cash, add as many as you can. It benefits you if you have a lot of rider. Like this color is a rider, you can add it. What does it do? It provides an automatic increase in benefit.
You know,
Because
Aflac.
Aflac is a rider too. No, Aflac is a company. I have
Right,
heard about it. It's a company, yeah.
right. They sell disability insurance and stuff like that. They go
Yes,
to the
yes, it's a
job.
company that handles that. But I don't know whether they are really life insurance company. That is what I don't know.
Mm.
But I know some people have it.
Yeah, I bought it one time. I didn't understand much, but I know they pay me when I got sick.
Or they help you when you get sick?
Yeah,
How many times?
I don't have a clue, but they gave me $46,000.
All right, which means you sign in for it when you're at work.
So I was paying like $120 a month. That's what it costs. And then I did my brain surgery, and the guy, I keep like applying, and I didn't understand. They wouldn't approve it. And I called the guy who came to my job and sold it. And he said, I'm signing up the wrong papers. And as soon as he did it, like he did it yesterday, today, they sent me the check. It was in my account. But
In
I'm now
fact,
learning about insurance. I don't even know what I did then. I
yeah,
just
but
buy something, they come to the job, and everybody was like, it's good, you can do it when you get sick or that. And but yeah, and it did help. It did help.
yeah, if AFLAC provides voluntary supplementary insurance designed to cover out-of-pocket expenses that major medical insurance does not. So we already did it yesterday on medical insurance. Some of the things that major medical insurance cannot cover, the AFLAC can do that.
Mm.
Yeah. More especially when your person have a accident, cancer, critical illness, hospital stays, and short-term disability. They often come up to cover that. It's a payroll deduction.
Mm-hmm.
All right. So COLA is a rider. Then credit disability insurance. Credit disability insurance. I want people to pay attention to credit disability insurance, decreasing term disability insurance. So credit disability insurance is a type of policy that makes payment on a loan if an insured borrower becomes disabled. Please remember this. Most times it's always in the questions. credit disability insurance, if you hear of credit disability insurance, it's about loan. Credit disability insurance is a policy you can add, they buy. What does it mean? For your loan. In case if you, the borrower, could not be able to pay due to disability, credit disability insurance will now come over to complete the payment.
Mm.
So you as the borrower, in this kind of policy, there is no beneficiary. The beneficiary is the borrower, is the lender. If I come now and borrow Maria 500,000, Maria will be paying me $1,000 every month to be in form of trying to repay the loan every month. I schedule her every month to pay me $1,000. Then I agreed that I give Maria the 500,000. But I told her, look, Maria, I want my 500,000 to be protected. So no matter what happened to you, I want to get my money. So I tell Maria, look, you're gonna put a disability policy for this loan. She agreed. She put disability policy. Probably the company analyzed their own, and maybe Maria should be paying around $200 or $150 plus the 1,000 he's paying me. So if Maria could not pay me due to probable disability, what happened? The insurance company will pay me my money. There is no beneficiary.
Mm.
Yeah, that's credit disability insurance. Credit insurance. When you talk about credit insurance without disability on it, means that you pay the loan situation. Now, instead of Maria not being able to pay the loan because of a disability, now you have credit insurance, means that Maria could not be able to pay that loan, maybe due to anything that make him not to pay it. Maybe probably due to lack of work, if you don't have any job, or maybe any circumstances might have resulted for her not being able to pay me. That's credit insurance. The credit disability means that situation we call if she is not able due to disability. You can see the difference between credit insurance and credit disability insurance. Now, let's look at decreasing term disability policy. Remember, we discussed this decreasing term insurance, of which we say is related to mortgage.
Mm-hmm.
Now, in decreasing term disability insurance, what does it do? It's a contract that covers what? A fixed period that starts on the date that are issued. As time lapses, the remaining number of potential monthly benefit payment decreases until it reaches zero. The credit disability policy are a form of decreasing term disability policy. Of course, if you look at it, you only know as you pay, the money continues to decrease. But more especially, it must be due to disability. But for our home, if you want to talk about decreasing term policy, we are talking about you having a policy on your home mortgage that as you pay, the mortgage decreases until what happened? It comes to zero. You pay off the loan. So when you hear of decreasing term policy, it's talking about loan. It's talking about mortgage. When you hear of the credit term insurance, it's talking about loan.
Oh.
Then when you hear of credit disability insurance, it's talking about what? Loan, but the borrower cannot pay due to disability. So there's something too, when you hear of decreasing term disability, it's the same thing. The person could not be able to pay due to disability. So these are just the same thing. They keep recycle it. Credit insurance, term insurance, credit and credit disability insurance, decreasing term insurance, decreasing term disability insurance. Correct. Delayed disability provision is what is a provision applied. This provision applies to disability income policy that allows a specific period after an accident for a disability to develop, during which the insured remains eligible for benefit. Most disability policies offer this benefit, which allow an extension of the time between an occurrence and the resulting disability, during which the policy will still cover a total disability. So that's delayed disability provision. The most important one I want you to pay attention here is what? Decreasing disability insurance. I mean, credit term insurance, credit disability insurance, decreasing term policy, decreasing term disability policy. So that's the things you will have to know here.
Credit disability insurance, decreasing term disability policy, credit insurance.
Yeah, credit insurance.
Okay. Credit insurance, I'm not gonna pay attention to it, I cannot tie out there.
Yeah, just be able to differentiate the four. Virtually four of them are the same, almost the same thing. Just
Credit
addition of disability on them. That's what changes it.
right.
Yeah.
I see that.
Yeah, that's just what, if you look at it, you see that the only thing that changes when you add disability on it. If not,
Yes.
it's the
But
same ones.
when I see a question, I can figure it out.
So let's look at disability. All right, disability buyout plan is a form of buy-sell agreement that's funded by disability insurance policies. The contractual agreement uses insurance to buy out a fellow owner's share of the business if that owner becomes disabled. Let's look at, without adding disability, let's look at buyout plan. Buyout plan is a kind of policy. If two persons has an agreement or have a company, if the other person is not being able to perform his own part, and the person that is performing his own part can buy out the other person's plan. The result of that is to make sure that the company does not fold. Then when you come to disability, two people have company. There's a buyout of disability buyout option, which includes disability buyout option. In that buyout option, if one of them could not be able to do anything due to disability, then the person who is okay will buy out the right of the other person who cannot be able to do something. So that is for that. Now we are coming back to another period, which we called elimination period. We're gonna jump some things now. Elimination period. Remember, what period did we do before we entered? What period? We have said one period before. Who can remember?
The payout.
We talk about benefit period. Everybody knows what benefit period. The one that we link to premium.
The waiting.
Benefit period. What is benefit period? Who can remember what is benefit period?
The time when it's been the amount, like how long you're gonna be paid.
That is the benefit period. Remember, we said if the benefit period is long, the premium it will be higher. I think we said that. All right. So now let's talk about elimination period. So I want somebody to write down elimination period. Remember, I told you anytime you see period, write it down and write the meaning. Otherwise, there's a lot of them. You're going to confuse you. So for you to know it, you have to be at least jotting something down. So let's look at elimination period. Now we have known what benefit period is. Let's look at elimination period. He said this is the duration of time between the death of an insured disability and the start of the benefit period, during which what benefits are payable. So that is the elimination period. From the time the person gets disabled to the time the person begins to talk about payment claim is what we call elimination period. So those periods are eliminated, those periods are not paid for. The elimination period is always 1 month, which is 30 days. So if somebody, let's assume Mr. Jane or Mr. B has an accident this month, which is today is 11th of February, and the person and Mr. B has a disability. From the period he has that disability, he now filed a claim. From the period he has that disability, the when the claim is supposed to be paid is what we call elimination period. Is that clear? I want people to say something. If you are not getting it, just say something.
Yes, clear.
How many of us? We have almost 17 here, people here.
Yeah, we are listening.
But yeah, people should be responding so it will be easier. So that's the elimination period. And because I told you, anytime we see elimination period, please just take a pen, have your small booklet, write it down. There's a lot of them. So just like we finish a benefit period, we want to know what benefit period is. Describe it on your own words so you can be able to explain to anybody. Now we are talking about elimination period. We say elimination period is that period from the time that disability occurs till the time you start to get benefit. That's from the time the disability occurs till when benefit period starts. Is what we call elimination period. So which means you have to know all of them. So let's go to, all right, the elimination period is a disability policy deductible that directly correlates with the cost of the policy. A longer elimination period, higher deductible means a lower premium. All right, let's see another one that will bring confusion now. See this one I highlighted? Remember, we connected benefit period with premium. We said the higher the premium, the longer the benefit period. That's what we said. Now, we said the elimination period is from the time the disability occurs till when you begin to receive benefit. That is what elimination period. So now we said the longer elimination period we have, which is higher deductible, means a lower premium. Can somebody relate it? The longer benefit elimination period we have, the lower premium. But we said benefit period, the longer benefit period we have, the higher what? The higher benefit, the higher the premium. But in the elimination period, we said the longer elimination period we have means what? A lower premium. So somebody can write it down. I know it confusing. Any question on that? We define the elimination period and we connect it with premium. We define benefit period and we connected it to premium. The benefit period is what? The period in which when you start receiving benefit till when it ends. That period is what we call the benefit period. We now come to elimination period. We say elimination period is the time from the time the insured disability starts till when you till when you start receiving benefits. When the benefit period starts, from the time the disability occurs till when you start receiving your benefit. That's elimination period. We now said the longer the elimination period, the higher, which is higher deductible, means what? A lower benefit, a lower premium. The longer the elimination period, the lower the premium. All right. All right, let's look at Federal Insurance Contribution Act, FICA. This is what guys, they reduce this FICA, they remove it from their taxes. It covers your Medicare, it covers your Social Security. The FICA tax is about 7.65%. You contribute 7.65% to your FICA, and that 7.65% is for your Social Security and your Medicare. Your Medicare, you contribute 1.46% of your check goes to your Medicare. Then the remaining 6.30 or 32, 35 goes to what? Your Social Security. Now, remember we said Social Security is funded by what? By the employee, the employer, and the self-employed. Government do not fund Social Security. Social Security is being funded by the employer, the employee, and the self-employed. So the employee, you contribute what? 7.65% to fund Social Security and Medicare. So that's how it is run. So the FICA comes from your paycheck. Your FICA, if you look at your paycheck, if you get your paycheck, don't look on top of it. Look through the paycheck. You see FICA. You see FICA taxes, which is the money you pay from your paycheck. They reduce it before you pay your money. That's what company does. Except they give you 1099. If they give you 1099, they do not remove your tax. But if they do not give you 1099, they give you check If they give you check, they have removed what? If they give you check, they have removed the tax. They have removed the taxes. If they give you 1099, they have not removed the taxes. They want you to add your expenses. Then, if you add the expenses, what I want 1099 is bring out all your expenses. What you
Excuse me.
spend.
Question.
Uh-huh.
Which one is better, 1099 or for them to remove the taxes by themselves?
It has two edges, two-edged sword. It's two-edged sword. But however, I would like to put my expenses by myself
Okay.
than for them to tax. I would like to put my expenses by myself. So I would prefer 1099 to check.
Okay.
Yes. Because if you have 1099, you have the freedom to put in everything you spend. Even the food you eat while at work, you have to increase it as an expense. The fuel you bought, you have to increase it. But in the one that pay the check they're giving you, did they put the food? No. Did they put the gases? They put the wear and tear of your car going to work every day. The uniform you bought, did they put it for those who work in the healthcare field? The shoes you wear to work, those are expenses. The snacks, even the snacks you bought at work, they are expenses. So you have 1099, you can be able to itemize all those. That will help you to figure out all the expenses. And remember, when you figure out all the expenses, they will now bring your income, your earning. They minus it from your expenses, whatever remains, what they tax you on.
Hmm.
You can see that 1099 is better for you than 1099 is far better to you than check. If somebody give you 1099, means that person wants you to write whatever, write your expenses. When you use it to file tax, then the tax person will now ask a question based on your expenses. You put your expenses, now put it down on the 1099 paper.
A lot of these jobs in New York with
Sorry?
agency, a lot of these agency job, nursing jobs, that's what they do, 1099.
Yeah, they give you 1099, collect it, no problem.
Mhm.
After all, when you go to that work, you fly to that state. Did you walk to that? You trek to that state? No, you fly. So the air ticket should go there. If you use
Mhm.
Uber or Lyft, that ticket should go there.
Mhm.
All of them are expenses. So, but sometimes they give you 1099, you'll be crying. It's ignorance. Most often we pay for ignorance.
Mhm.
So you check your Africa tax, you see all those things there. Then the flat amount approach, this approach is used in individual insurance contract. This policy benefits are defined as set amount that what can be altered only by policy change or contract provision, regardless of insured income changes. Now, look at fully insured. Remember, Social Security say for you to be fully insured in Social Security, you must have worked for 40 quarters or 10 years. Does it mean you have to work for that 10 years in one company? No. Collectively, the number of years you have worked must have reached up to 10 years for you to be what? Fully insured in Social Security. That means for you to fully receive the benefit. So let's look at guaranteed, fully insured. This is a term used by Social Security Administration to describe individuals who are eligible for Social Security retirement and disability benefits. So let's look at guaranteed insurability rider. Of course, this rider guarantees an insurability and gives the insured the right to buy additional amount of disability income coverage at predetermined times in the future without proof of good health. So guaranteed insurability rider. If you have the rider, you can buy more policy, additional amount of disability income coverage at any time you want. So do you think insurance company will be giving it? this guaranteed disability rider? I don't think so. Yeah, it is there, but how many of them will give it? Because to give you the privilege to be buying any amount of income coverage you need, disability income coverage you need at any time without you showing a proof of disability. I mean, proof of insurability. I don't think most insurance companies do that, because if they do that, they may, in essence, get a high risk patient, which the next day they pay the benefit, the person dies. So they may not want to do that. That is my own thinking. Every person may think differently, but I don't think insurance company would like to do that, because nobody insurance company are here to make profit, so they don't want to lose. If they continue to pay that benefit, you know what it means? That they are spending a whole lot of money, and it's going to affect them financially. And most of the benefit now are mandatory. They give you conditions that you can pay it. So guarantee renewable. The provision requires the insurer to renew an existing insurance policy up to the established termination age, unless the insured fails to pay the premium. Guarantee renewable. Require the insurer. Who is the insurer? The insurance company, to renew existing insurance policy up to established termination age, unless the insured fails to pay the premium. So these are the things that sometimes we should be able to know it. We have, remember we talk about confinement, hospital confinement rider. A rider provides additional benefit for each day an insured is in the hospital, over and above the basic policy benefits. Then impairment waiver, a rider also known as impairment waiver. All these are riders. It can be included, it can be excluded. If you do, it's not gonna force, nobody's gonna force you to have a rider. But if you decide to have a rider, you choose a good rider that you can have that can benefit you as a person or your family. So when you come to this level, you are determining what is good for you. You're going to determine by yourself what is good for you. You're going to look at what kind of rider you have. And if you don't have the knowledge, you'll be swimming, paying for your ignorance. Let me tell you one story. One of our agents gave us the other day when we were in a training. She was giving us experience how she writes her first policy. You will laugh there. She paid consultation fee. She paid consultation fee of $2,000 to somebody to write policy for her. You guys can't believe that. So she went to the office. The office was well decorated. A beautiful office. They say her before she can see the man, she have to pay $2,000 before the man can write policy for her. She paid $2,000.
Did she get it?
Huh?
Did she get it, really?
Don't be to write policy. The man write policy for her now.
I hope it was a good one.
And finally, after writing the policy, it was stamp policy.
She should go back. She should have go back for she money.
Yeah, right. Is that not illegal?
What? No, it's not illegal. It's services.
Oh my God.
It's services. So what I'm saying that most times we pay for
Ignorance, yeah?
we pay for our ignorance. Most of the things we pay is our ignorance. If the lady said this and you will laugh tired, she is in Missouri. In fact, when you guys pass and begin to attend the larger training, because she doesn't know most time when she's speaking, she just say it, you will laugh tired. You laugh tired. So she paid the $2,000. And of course, she stand. Wait before you reach out. Oh my God. So this what she paid is what you now can sit down and be on the Zoom and do for her. If you are doing to some of our people, they think they are helping you. But they don't know you're helping them. So she paid $2,000 consultation fee. God help me. So
God have mercy on that criminal.
yeah, most of the things we pay, honestly, we are paying for ignorance, for not knowing something. Most of the failures is because we don't know. There's something, in fact, by the time you come into this business well, you understand that there's some money you are wasting, you're not supposed to waste. There's someone, for instance, this one is a very easy one. Somebody was working in company A and now retired from company A or resigned from company A, went to company B. And in company A, when he or she was working on company A, he has a 401k. Then when he moved to company B, he have another 401k there. Now the same person will now pay people to transfer the 401k in company A to company B to be the same accounts. He pay people. Is that not ignorant? Then some other person will say he don't want to transfer to company B. He want to keep it there. He keep your 401k there at where you're not working. And somebody be managing for you, it for you, and you are paying 2% of your hard-earned money to that person annually for taking care of your account. So there's so many things to learn. There's so many things to remove from our life. Imagine, let's assume let's assume that 2%. No, nobody want to know how much is there. Let's assume 100,000 is there, and you are paying 2% of 100,000 every year, which means almost 2,000. Let me see. You are paying almost 2,000. Yeah, it's 2,000. You are paying 2,000 to that person, unknown figure, every year, as a manager of your account on your 401k or 403b. Whether you are losing or you are gaining, you pay this 2,000 because somebody is managing the account. Yeah. You keep that account, you are moved from company A, you leave it there, you are now in company B, you leave that account there. The account sometimes we lose, the account sometimes we gain. Whether you gain or you lose, this man you are paying 2,000.
Can't do nothing for you.
No, what is he doing? That's where I'm coming.
Just collecting your money.
Yeah, of course. What is he doing for you? What is he managing?
Nothing. Oh my God.
God help us. So gradually you will come to understand this. So the best thing for that person who is company A that left company B, moved to company B and have 401k company A, what's the best thing for you to do? Take that account and go and lock it on annuity and leave it there. You'll be getting money. You're not paying anybody, any fucking human being, anything. No. It's crazy. No, honestly, it's crazy. Sometimes, if you understand it, by the time you get deep into it, you understand that some of the things we do is just totally foolishness. And some of those who are benefiting from it, and when you are talking to them, they'll be talking to you as if they are giving you
Oh,
money.
yes. Oh, yes. Like some big shot, and they're the ones who make you wake up this morning.
Yeah, they'll be talking to you as if they are specialists. They are giving the best ad.
That's so true. Oh my God.
Oh, God help us. So long-term disability insurance policy, if disability income policy features monthly benefit payment and benefit period of 10 or more years. When you have long-term disability policy, all right, somebody was saying before, we have short-term and long-term. Long-term benefit can be 2 or more years. Short-term, most time can be 3 to 6 months. So that's long-term disability insurance policy. Is the income policy. You can just write it as a single as policy of its own. It features monthly benefit payment and a benefit period of 2 or more years if the person becomes disabled. Now, loss of earning test, this one, material duties, this refers to actual tasks or activities that workers must complete in the course of doing their job. That's material duties. Mobility. Remember, mobility, sometimes people have to normally confuse mortality. It's not the same. Mobility is a measures the risk of becoming disabled and can take into account personal as well as occupational circumstances. It's a measure of determining of the risk of becoming ill or of the risk of becoming disabled. That's morbidity. It's not the same thing with mortality. So please, you normally see it, sometimes you see it, you get confused with it. The non-cancelable, remember, when you do your policy, the 2 years is what we call what? Who can remember what is 2 years before? 2 years, when you write a policy, 2 years.
The contestable
The
period
contestable
and the
period.
incontestable.
Good. The contestable period fall into cancelable period. The non-cancelable period means that after the contestability period, which means at that period, you can no longer cancel the person's policy due to any defect, so maybe any issue you found out. But during the contestable period, the policy can be cancelled by the insurance company. So the non-cancelable, or guaranteed renewable, this provision states that the insurer must renew an insurance policy up to the established termination age, unless the insurer fails to pay premium. Of course, every term policy has non-cancelable on it, term on it, any term policy, because the only way the term policy can be terminated is when you do not pay your premium. I think everybody knows that if you don't pay your premium, the policy will terminate. So, which means every policy have this non-cancelable or non-cancelable and guaranteed renewable. Of course, the term insurance is guaranteed renewable. The only thing that can make it not to renew is that when you do not pay your what? Premium. So, as the insurance carrier can neither change the policy terms nor the premium rate. In term insurance, they're not going to change the policy term, not the premium rate. What if you're paying $100 on your term insurance today? You'll be paying $100 all through the day, all through the year, until the policy terms, and is renewable. So when the policy terms, you are required to renew it if you can afford the premium. However, remember, the premium may not be the same because the new premium will depend on your new age. So that's one problem with term insurance. If you have a term insurance, maybe you have 20 term insurance or 10 term or 15 term or 30 term insurance. Of course, I've not seen more than 30 term insurance. If you have that, what happened? If you have that, if you reach, let's assume I have one. That is the first policy I have. I have it in 2007. It's 30 years term. It will terminate when I become 70. Yeah. When I become 70, I think, or 59, something like that. Either 69 or 70. That's when it's done. So it's 30 years term. That policy cannot terminate. It cannot terminate because only when I stop paying the premium, that's when it terminates. Or again, because it's renewable. It's renewable at 70 years. When I reach 70 years, if I do not renew that policy, what happened? I will lose it. But because it's renewable, if I renew it, the policy continues. But remember, if I'm going to renew it, I'm not going to renew it at the age I bought the policy. No, I'm not going to renew it based on the new age of 70 years. And the new age of 70 years, you do not expect it. That policy, I'm paying how much, either 58 or what, $68, I can't remember. I'm paying on it. So if I'm paying that amount when I wrote the policy, when I was 30-something, something like that. So now, if I want to renew when I get to 70, that policy I'm paying $58. It cannot be $58. At that age of 70, it may be up to $300 to $400 or even $500. Because the renewal now be based on the age of 70. So everybody here who has stamp policy, that is exactly what you see. And if you do not renew it, you lose everything. You lose all the ones you have been paying before, except you have what we call return of premium rider. And that is the only rider you have in term policy. Yes, if you don't have return of premium rider, you're going to lose everything. If you have return of premium rider, what you're going to get is they're going to bring out all the premium you have paid. They remove all expenses, office expenses, they remove it, then they give you the balance because you have return of premium rider. If you do not have return of premium rider, the money, everything you have paid, gone. So that's stamp policy. Most of us here have stamp policy. It's not bad thing, but however, you bought it out of ignorance. Now that you have known, I don't think, although some people still want to term life insurance, they will tell you that it's cheapest. Of course, it's the cheapest, but it's also the costliest. It's cheap when you buy it, but what of when you renew it? It's no longer going to be cheap. It have to be if it becomes expensive. And what it means, you're going to lose policy when you need it. And when do you think you need policy? It's when you start growing old. Of course, there's no benefit attached to it. There's no life benefit attached to it. Every benefit on term policy is what? Upon death. So all this is, everyone has to know it. So if you have term policy, think about it and look what you're going to do. However, you can convert your term policy to whole life policy with your cash value. If your company, depending on how many years, my own company is 3 years. Of course, when we know this, what we know today, I will call them to change it. They said, no, it has passed 3 years, so I couldn't be able to convert it again. So if you have term policy, check your company whether it's still due. My dear, if it's due, convert it. It's just of no use to you. It's not going to benefit you. And moreover, ask the agent who wrote it for you, or if you can log into the account, find out if it has return of premium rider. If it does not have, then all the money you're paying is a waste. Period. Because when you get to the year of the term, when it comes, it's going to be expensive. And I don't think by then you must have retired from their job. I don't think you can be able to pay $400, $500, $600 or $700 or $1,000 to keep the term policy, which does not have any effect to you except your loved one, your beneficiary. All right. So non-disability injury. So this benefit is what? It applies to injuries that may have resulted from accident but are not necessarily disabling. That is non-disability injury. Accidents, injury that come from accident but that are not disabling. So you can get injured from accident, you are still able to walk, you're still able to feed yourself, you're still able to go to work, do everything. That is non-disabling injuries. Non-occupational coverage, because the coverage is provided by what? Disability income policy that does not underwrite based on employment and may not provide benefits of loss. Occupational coverage, disability income insurance policy that underwrites coverage based on what? One's occupation. One's occupation, the term applied when determining a person's disability. Remember the definition for disability: when you cannot be able to do your own occupation, based on your experience, based on your training, based on your education, you cannot be able to do it. And such a disability may last up to 1 year and may lead to death. Remember that. Percentage and in permanent disability, of course, the person totally disabled, presumptive disability. Primary insurance amount, PIA, is the basic monthly benefit available to cover individuals. Social Security basis the PIA on a person's income and the taxes on that income. Primary insurance amount, the monthly benefit available to covered individuals. For instance, if you have a disability income insurance and you are disabled, you file for a claim, the PIA, which is the primary insurance amount, is the monthly benefit you receive. That is the PIA. PIA is what? The monthly benefit you received. It is available to you or to you as an individual when you file that claim. That is primary insurance amounts. PIA. All right. So let's look at probationary period. This is another period. I want people to write it down. Probationary period. What is it? It's a specific number of days, 7 to 30 days, that begins on the effective date of insurance policy. During this period, what happened? The policy only covers claims of accident, not for illness. Probationary period is a specific number of days, 7 to 30 days, that begins on the effective date of insurance policy. All right. Probationary period is always there in everything, more especially in our health insurance, disability insurance. When you put in this, when you bought the policy, this is a disability policy, you buy the policy. The effective date of that policy does not start immediately. The policy starts, stay, and they say the policy kick off so date. Meanwhile, you have signing, they say policy will kick on so date. That date, so date is what called the probationary period. They want to use that probationary period to check your status, to check whether you have any pre-existing condition. They want to use it to check. That will help them to do what? Either to ratify the risk level, to increase their premium, or to decrease their premium. So the probationary period is a number which is from 7 to 30 days that begins on the effective date of an insurance policy. When the policy started, the probationary period starts from the day the policy started. But that day it started, was it the day the policy become effective? No. The right up date is supposed to be the effective date, but the policy, they say, well, this policy will kick off so date. Meanwhile, everything has been finalized. They tell you, oh, it will kick off in 2 weeks' time, in 15th. All of us must have witnessed.
Professor, please, can you state this over for me? Because I'm not grabbing it. Please.
Which one? You want me to say probationary period?
Yes.
All
Yes,
right.
please.
You know, elimination period, you know, benefit period.
Yes.
You know, when we say a policy is effective, that is the date the policy is supposed to kick off.
Mm-hmm.
Now we said the number, the probationary period was a specific number. Normally, most times 7 to 30 days. That begins on the effective date of an insurance policy. So the probationary period becomes that period, the period before the policy effective date of policy begins, the covered period. For instance, if you buy the policy today, the probationary period gives them time to somehow do an internal investigation before you start, before the policy kick off, before you now tell you that this policy can kick off. If you buy policy, they tell you, all right, you sign in, the policy kick off on 15th of June, I mean 15th of, maybe 15th of February. Meanwhile, you have concluded everything. They tell you that the policy will kick off or so date. That is those from the date, the effective date, the date you sign into that policy till when the policy kick off is the word probationary period. Remember, in our life insurance definition, when we say you do application without premium and you do application with premium, remember what we said about the effective date. The effective date when you do application with premium is the date you wrote that policy. Is the date you paid that initial premium. Is the date you submitted that premium. The date you write on that check, the date you fill the application, which is supposed to be the date you wrote you write the check, the date the application was filled. That date is the effective date. But is the policy effective? No, until when approved. So the probationary period will be from the time you have paid into that policy till when the policy becomes effective. That's the probationary period. I'm using life insurance to give an instance of that. But the health insurance is the same thing. From the date the policy is supposed to kick off till when the policy becomes in force. That's the probationary period. Is that okay?
Yes.
All right, so let's look. Recurrent disability provision is a disability income policy provision specify a period during which the occurrence of disability is considered a continuation of period disability claim. In recurrent disability provision, the insurance company does not pay 2 claims at the same time. We said it before. If you go and if somebody cut his leg and file a claim, and after 2 weeks, the person again cut his hand and file a claim. What we are saying is this: the company will not pay you the 2 benefits. No, they will choose one to pay you. So the recurrent disability provision means that the disability income provision specify a period during which what the resources of the reoccurrence of disability is considered a continuation of period disability claim. So in those 2 disability you have, the one that cut your leg and the one that cut the hand, in that invariably you're supposed to file 2 disability for it because they don't occur at the same time. But however, the benefit period of the first one is still in force before the second one occurs. So the insurance company will not honor the two. It's going to take one. So the other one, you lose it. I hope it's correct now. So as such, what happened? The insurance resumed paying benefit without any elimination period. So in that case, remember what we said about the elimination period? Is the period from the time disability happened to when benefit period starts. That's the elimination period. Now, if these two events happen at the same time, this one happened before this one happened, and already the benefit period for the first one has started before the second one starts. The benefit period of the second one will go and be the same with the first one. They're not going to create another benefit period, because why would they do that? You see the same patient, you see the same number, you see the same everything. So they continue the benefit period from the first one. So if you decide, you can decide to sell it if you want. So, yeah. So let's look at rehabilitation benefits. This benefit facilitates vocational training to prepare an insured for a new occupation. Of course, that is rehabilitation. If somebody is disabled, of course, they'll give you the opportunity to rehabilitate. They want you to come back to work so that disability will stop. If you're disabled, I mean, you are working and you get hurt on the job, you have become disabled, you're collecting disability benefit. They want you to come back to work so that disability will stop. They want you to come back to work, go to rehabilitation phase and come back to work. So that's for them to stop paying, you know. They're not coming. These people want to make profit, you know that. They don't want to be paying. They want to make profit. So this is return on premium rider. What we say that only found in term life. Yep. So this rider refund the insured premium dollar for dollar without interest if the insured does not file a claim. The rider may extend for the life of the policy or a stipulated period. Short-term disability insurance. Remember, we have looked at long-term disability insurance. We look at long-term disability insurance, which is, all right, look at long-term disability insurance, which is what we said, long-term disability insurance income policy features monthly benefit payment and a benefit period of 2 or more years. Then the short term will not be 2 or more years. The short term will be less than that. All right, short term. This short term disability said the disability income policy, insurance policy, is characterized by weekly benefit payment and the benefit period of no more than 2 years. But this one said 2 to so many years. So group term, short-term disability policy tend to have a benefit period of no more than 26 weeks. So that is it. Social Security disability, SSID, you cannot get Social Security as far as except you are fully qualified or fully insured. And for you to fully insured, have to work 40 quarters or 10 years. Social Security rider, of course. Sustainable duties, temporary disability, waiver of premium. As there's no other serious thing here. So I think workers' compensation, that's the last one. Workers' compensation cannot be paying you while you are on Medicare, collecting Medicare. No, it doesn't work that way. So I think we are done for today. We start in the evening by 6 p.m. I think we have gone past the hours. For those who want the exam, we wish you guys success. If you do not make it, be glad to come back in the evening and tell us your own story. The fight continues from there. If you could not make it, it's not do or die. We have made up our mind that we're going to get this thing done. So if you go for the exam, you did not make it. It's not.
Go again.
Try again. So don't get discouraged. People make it 4 years. I've been 14 times before they make it. So don't get discouraged if you not make it the first time. Sometimes it's a way to, it's your story. When you begin the business, it becomes your story. Say, oh, I took it 1 time, I took it 2 times, I did not make it, but I still consist to make it. What I see in this business, I want to tell everybody now, is your level of persistence and your level of What grammar will I use that can fit it? Resilience. Yeah, level of persistence and resilience. That is what you see. I see. These two things what can make you to win in this business. You have to be resilient. You have to be persistent. And of course, you have to be coachable and teachable. That is the three things, qualities you need to succeed in this business. So we're going to see everybody by 6 p.m. For those who have gone for the exam, please, we pray that you pass. If you do not pass, come back here. All of us will meet. And we will direct you on the area you did not make it well. Print out the result sheet. The result sheet will tell you the area it did not do well. So you come back here, we sit down and go through it. Definitely, believe me, you get it done. It only depends on your mindset. Zero your mind that you're going to pass it. It's not a difficult exam, but it needs a little bit of what? Commitment. So that little bit of commitment is what we needed for you to pass. All right. Thank you, everybody. See you in the evening time.
Thank you so much.
Yeah, bye-bye.